What's your investing background as far as actually taking the income that you're earning from your active income and then investing it? Are you in passive deals? Or are you in buying more assets than the 20 unit? Or what does that look like for you?
One of the main things that I try to do is not to have too much concentrated risk. And since our entire business is based around commercial real estate,
Yeah.
I have invested into several properties. It's just stuff that I personally own without other investors.
Yeah.
But they have to be passive deals. That's the issue. Because the only way you can properly manage a property is if that's your main thing. And as somebody who works from, so I want to stay in my own lane. I don't want to run too many races and try to do like capital markets and also taking phone calls with clogged toilets and stuff like that. So no, I mean, they have to be third-party managed deals.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities, so you can take your commissions and turn them into cash flow. Here's your host, Randall. Let's dive in.
All right. Welcome back. It's good to have you here today. My guest is Jake Clopton. We're going to bring him on in just a second. He has a background in futures trading, and he's a debt broker for many different types of asset classes. So we cover some of what he's been working on and what he's seeing in the market today. He's also an owner-operator of his own deals in the Chicago area. And so we talk about some of those investments that he's had. I'm a little all over the place. We cover a bunch of different topics, and I'm curious about a lot of these things on myself. So I go into some detail to scratch my own itch that I can learn a little bit more about some of the things that he's working on. And he mentioned something at the end that, again, I pry into about bankruptcies and how we're seeing a little bit more of that coming up in the market. It's just, again, asking some dumb questions at the end. But I think if you're curious as well, and if there's a type of investment strategy that you're looking for, Jake has seen it and he's put finance or debt on it for his clients. So a wealth of knowledge, shares a bunch of information. And if you want to reach out to him, all of his contact information is in the show notes as well. If you're looking to finance a property, or looking for LP capital, or you're looking for joint venture LP capital come in, he is a resource for all of those things. Let's jump in and you can hear it from the man himself. And here we go. I'm learning more about what other people are working on, building the network and that sort of thing. So now I'm at the point where I got to start going on other people's shows now.
What's your typical audience?
Real estate agents. Yeah,
are you mainly like residential real estate agents or like commercial agents?
Both, man. So me personally, I'm heavy background in fix and flip, investing, single family, that sort of thing.
Okay.
Transitioned out into setting up a fund to buy commercial property and another crowd fund that we launched to do single family, buy, fix and flip, and then owner finance. And so that's like my background and what I've been working on. The multifamily fund that we have, we are just now in the early stages of it. It's just deal flow has been challenging in this. It was not the right time, I don't think, to launch a fund, but maybe, who knows?
Well, man, there's been a lot of times where people have not thought it was the right time. And then in hindsight, it was. Yeah. So, I don't know.
Yeah.
We'll see.
Yeah, same. So that's the background. And so I've brought on a bunch of operators for multifamily, for industrial, for all kinds of different asset classes. So we've talked about that. I had a bourbon fund on last week. We were talking about bourbon and investing alternative assets and that sort of thing and what the returns look like on that. So
wait, like investing in bottles of bourbon?
But like barrels. Yeah.
Oh, okay. I've heard that. Yeah, I've heard that.
Yeah. It was an interesting strategy. I've had crypto fund managers on. Really, the whole idea is to highlight alternative assets, investments, and things that real estate agents may otherwise not invest in or know about, whether that's real estate or that's crypto or that's anything that's going to actually build their cash flow. So I want to talk about commercial myself. I had a small multi-under contract, just had to back out of it because the debt and the property just didn't make sense. And so I'm looking at land, I'm looking at contractor garages. Like I just rented this place for my rehab company.
Oh,
and
okay.
And I'm looking at building things like this. I have a garage next door. It's a little warehouse. So financing for these types of projects, either ground up or purchase, we could talk something like that. Again, it's scratching my own itch here a little bit too much, but
sure.
It's like you're in the space, man. And then talking really about what you're doing. So it's good to have you on. All right. So I wanted to talk first. I was reading the forward of your book, and this is a topic that I was in a mastermind talking about funds and setting up funds and what investors are looking for right now. And you said something in the forward of your book that was, we're entering into a low yield environment, and we have been for some time because of certain economic factors that have happened over time. So with your unique perspective on the debt side of things, what trends are you seeing that are emerging as winning investment strategies that individual investors or sub-family office investors are actually employing right now?
Sure. So the book I wrote when rates were coming down.
Okay.
We're actually unwinding that low yield environment now for
Yeah.
sure. As we sit right now, I think a lot of family office investors and people that are looking to invest into funds they're looking for more meat on the bone than they were previously, and they're risk averse, right? So when they're going to so we do a lot of like LP equity arrangements also.
Okay.
And one of the major themes that equity funds turned to when rates started rising is they did a risk off strategy of moving from like LP common equity to pref equity. And that pref equity space is basically giving them like first priority in cash flows. It gives them a little bit less return, but it gives them more security than just investing into just common equity. So that was one of the major themes that we saw coming out of family offices once rates started rising. And the other is just looking for a lot higher IRRs and yield on cost in deals and being much pickier. There's a lot more deals going around than there is investor equity right now, it seems. Those investors are able to be a lot pickier than they were in the past.
That's interesting because I thought it was the opposite. I thought there's a lot of money sitting on the sidelines ready to be deployed, but not enough deal flow for that money to go into that are providing the returns. So is it
So
specifically in the
there's a
pref equity?
lot of money sitting on the sidelines, but it's from what I'm seeing, it's doing just that. It's sitting on the sidelines.
Yeah.
And the money that is willing to be in the market is much pickier. I am seeing a lot of equity funds that are like still saying, hey, send us deals, let us look at stuff, but they're not executing on anything. That's some of the biggest difference is a lot of these guys really hit pause for a long time. Right now, I'm seeing a lot more of them start to really take serious looks at things. So I think the basis and the deals I'm seeing out in the market, either prices are starting to come down, and that's some of that too, but some of the underlying economics of these properties are starting to come up as well. And some of the lending side has alleviated a little bit on the cost of capital. So more deals are coming together. I'm starting to see more acquisitions and people chasing them. Equity's still a little nervous and definitely wanting higher returns. A lot of the stuff that I'm seeing get capitalized in the market is some like special use properties, right? So we're doing, for instance, lots of storage, seeing a lot of equity chasing storage deals, I mean, kind of alternative asset classes like car washes and stuff like that. The yield on cost in building like a multifamily property right now is still pretty low on average from what I've seen. And a lot of those, it's just hard to pencil if you're an equity player.
Yeah. So working with LPs in order to come into the pref equity side, are any of them concerned that, again, I've seen a lot of bailouts from pref equity on multifamily deals specifically because that's been the thing that I've been most focused on. And I wonder if it's good money chasing after bad, or is it they're positioned in a way where they have governance on the deal so they can come take it over if they have to, and they're willing to inject the extra equity if needed to save a deal.
I think a lot of what I'm saying is the latter, right?
Okay.
The funny thing with a lot of these properties, there's really, if you look at some of these distressed properties or the ones that are in trouble, there's really nothing wrong with the property itself. A lot of these ones that I see need rescue capital, like they're 95% occupied and performing and fine. It was just the assumptions of when they went in didn't exactly pan out, and they just took on too much leverage for when rates went up. So if you were planning on a certain amount of rent growth and you took on 85% LTC debt with some value add deal and you needed a 4% rate to take you out and all that rent growth, it just didn't happen. There's no margin for error. I'm working on several of those right now, right? So when a lot of these like CLO bridge loans are coming due, let's say they had 15 million bucks worth of debt on it for bridge debt, and the exit was going to be an agency loan. And now because of where rates are and maybe the rent growth didn't pan out, that agency loan, they only get to 12 million bucks. So you've got that gap. That's where we're seeing a lot of pref equity guys step in. And I'm not going to say whether or not they're predatory in it, but they are in a secure position and they're at a good basis where if they had to step in, they certainly could. And I think they would be in at a decent basis, but all of that equity above them is still at risk for sure.
Yeah. That's one thing that I've noticed. I'm on a number of deals and one of them is in that position. And we're like, okay, are they what's going to happen here? So I was just curious on your take on what you're seeing and how those things are being worked out on the back end, because that's been a conversation around a lot of
a lot of these deals, man. It is what it is, right? Because most of the deals I'm seeing that are getting rescue capital come in, like the only alternative would be just to sell the property. Yeah. And a lot of times that works out to the equity being completely wiped out.
For sure. Yeah.
So they might as well mortgage their future a little bit and get some pref equity and see if, they can sell it and 5 years and at least get their original equity that went in back. That's what I'm seeing in a lot of deals. It's more capital preservation than still trying to make a return.
Okay. And so when you're putting those together, what kind of returns are the pref guys looking for? Or what are they offering, I guess, the LP side?
Yeah, I'm seeing pref priced double digits up to 14%,
Okay.
11 to 14, somewhere in there. I
Yeah.
think that's really average. A lot of the pref we're doing is like single digit $1 million pref deals, like 1 to 5 million.
Okay.
That's really where I'm seeing a price. But the pref itself is structured as like a current pay and like an accrual. So a lot of these they'll require 7 current pay and the rest of it just defers or accruals,
Back end.
until 3 years out. Yeah. And then it's paid off.
Okay. Okay. That makes sense. And you said you're seeing more deal flow. So again, is there a specific asset class? You mentioned storage. Brother does storage. I've talked to him about storage quite a bit. And I know some of the guys that are doing a lot of that. And they have challenges as well, right? There's apparently some lawsuit that's coming out that's going to affect their dynamic rent pricing. I don't know if you've heard about this or not, but I was curious if I heard this on another podcast, so it may not be 100% accurate, but AJ Osborne's a guy that does a ton of content for storage. And they talked about it and how some of the big operators are coming under fire essentially for getting people in at $1 and then jacking it up and then jacking it up and then jacking it because it's 1 month rent terms.
Right. That makes sense.
But again, I don't want to harp on that, but just curious. So you're seeing that a lot of capital's flowing into those deals and the returns are still there. There's no real issues with oversaturation in that asset class that you're seeing right now.
I think what I'm seeing in the storage space is there's a market in like the smaller storage facility space.
Okay.
In more like secondary and tertiary markets.
Okay.
Where some of those are still very undersupplied.
Yeah, yeah.
And or there's like mom and pop facilities that people are aggregating. So a lot of what I'm seeing is these kind of like small to middle market storage companies coming online that have the intention of going in and adding new supply through construction in underserved markets.
Yep.
And or taking over like legacy properties that are just mismanaged or like the guy's just old and retired. I'm doing a lot of deals with the guys moving forward. So that is a big space in storage. Some of the larger facilities, when you get up to the Publix and the extra space, that space, depending on where you are, probably is getting a little saturated. Like I did see an extra deal where the Public came in right across the street, cut rents, and the extra deal got correct. You know what I mean?
Yeah.
But so I am seeing more competition on that side with the larger companies like that and some of the larger facilities for sure. Okay. But in this like small space, I think there's still room to run a bit and aggregate some of those portfolios. We'll see how much longer that goes, right? I've been doing this for 15 years, so I've seen this movie like a whole bunch of times. I've seen that movie several times, and they've probably got another 18, 24 months to run before a lot of that's eaten up.
Yeah, got it. Okay. And then you mentioned one other thing before we move on, car washes, right? So I was around San Antonio, I'm here, and they have been blowing up. The drive-through, the tunnel is back, right? Yep. And then the free vacuum and all of that. They're all over the place now. They're going crazy. I think a lot of PE firms went in and just financed some of that stuff. Maybe not, but I've washed my car more times since having that $30 membership a month. And so I see the value in it and they're going up all over the place. I was literally looking at franchise models for that to put one up where there's not one here in San Antonio. So I want to talk about financing and what that looks like, because if you're doing that type of financing, it's not something that I've ever even looked into. It's just, I see them, I've used them personally, and I'm like, okay, this is great. I love these. They're much easier, better, faster than me getting out scrubbing my car with the traditional coin operated car washes. So what does that look like when you're going through and financing something like that? What kind of debt can you put on those things? And then just what are the returns that you are seeing? Again, I imagine you get to see the return profile on some of these deals, not just the finance side. You're actually seeing the business plan and some of the things they're going through. So yeah, let's talk car washes for a second.
Sure. So in any deal where I try to figure out like what kind of like debt is the most efficient, really start with the equity stack and go from there. Your lowest cost capital is always going to be banks, credit unions, stuff like that. But if let's say you're doing like a GPLP syndication, like that's going to be really hard to do after maybe the first couple of deals. But also most of the time, the GP is just not willing to sign on 100% of the debt if they're only taking 10 to 20% of the deal.
Yeah.
So there's certainly private money out there for pretty much all this stuff, as well as bank credit union debt. Talk about the two separately. Private money, there's a lot of debt funds out there. You got to be careful in that space sometimes because a lot of debt funds There's guys that aren't even really direct lenders themselves. There's some that do like these A/B structures, and they have line lenders, and you have to be cognizant of that because they need extra approvals. And then there's other guys that just have the money sitting there. So I think when you're dealing with private lenders, it's not very transparent. It's not like dealing with a bank where you know how they're capitalized. So one of the things I always tell people is be careful of like their approval process and where their money comes from, because it may be very different than you actually are assuming when you go in. Just the general theme with debt funds, and especially like special use properties, is a little bit lower leverage, and probably the average rate I'm seeing from debt funds, especially for construction and stuff like this, is double digits for sure. Prime is still in the eights. With a debt fund, it's certainly going to be in the double digits. Some are still requiring PGs. Others can let you get away with just a completion guarantee, which it's still a personal guarantee to you're guaranteeing it gets built. Yeah, once it gets built, then that kind of goes away. Banks and credit unions are a really interesting space right now. I would say maybe 3/4 of what we do goes through conventional lending like that. It's just with all the bank stuff that's going on, it's just a completely different environment than it was 2 years ago, right? 2 years ago, these banks had so much liquidity, they didn't know what to do with themselves, and they were tripping over themselves to put out money and to lend. There's really 3 types of banks out there, okay? There's ones that are still pretty capitalized and they've got money to lend. There's ones that don't really have it and they want large deposit relationships to lend. Like, for instance, I got one loan quote from a bank where I think they were going to lend 10 million bucks, but they wanted 30% in compensating deposits to lend to them. And I'm like,
yeah,
what are you talking about? Like, why are we even doing this? Yeah. And then candidly, there's others that really aren't lending at all. They haven't really come out and say, okay, we're not lending, but they're just really not.
Yeah.
The issue with dealing with those types of lenders is you don't really know which one they are until you get in and do it and really go through their process and drill into what they need. And so like on any one deal, for instance, when we're arranging like bank or private debt fund financing, we may talk to 150 different lenders in this space to really wrap in everybody and figure out like, hey, is this somebody that's actually going to get an approval, and are they going to require huge deposits and stuff like that? As far as like both sides, there's certain liquidity on both sides. It's just some of it comes with more strings attached on each side. And then you just have to really be cognizant of the approval process, because on both sides, there's risk, right? There's risk with banks where some of them have this 3-tiered approval process. And then again, on the private lending side, you got to understand if that's really in-house approval or if they have to go out and get it from somebody else.
Yeah. Yeah. You just mentioned, right, talking to 150 banks. All right. I got to ask then. So what does your operation look like? Is it you and you're on the phone? You got 20 people? Like what does it take to be able to do that?
Yeah, I can go into our firm as a whole. We're really a commercial real estate service firm. So like I run all of our capital markets.
Okay.
Then we're also actually an in-house commercial property insurance company. We're a 1031 qualified intermediary.
Yep.
We do some commercial solar installation and financial modeling. I don't run any of the other sides, like other guys head those up. As far as our capital markets, it's a pretty efficient process. Not to go into too much to give away what we do. There's a lot of people supporting me on my side. So but you're not wrong. It is a lot of work to talk to that many bankers. A lot of the conversations can be short. Hey, not for us or this, but we will end up having thoughtful conversations with, out of 150, probably 20 to 30 bankers to try to figure out if it's something that actually works. Once you get past some of the guys that just aren't a fit or just need to pass for whatever reason.
So having gone through this process myself, I'm using debt broker or a loan assistant. I don't know. He called himself something special in this most recent deal. I'll tell you offline here. I found that the process was not as transparent as I would have hoped, right? If I were dealing directly with the bank or talking directly and getting the real story, right? We need X, Y, and Z, or hey, this thing is not going to really work out the way. So what do you do in your operation that allows for that transparency when you're working with a client, dealing with 25 different lenders? When you lock it in, are there anything specific and special that you guys do that if I'm working with somebody locally, I can expect the same thing?
Once we get terms, and let's say we get terms, a term sheet are out. Is that right? Our process is we try to get everybody connected and really like direct communication going, right? Because once we're through there, like you're going to be dealing with this lender for the next 5 or 10 years, maybe, right? Yeah. There's a relationship that needs to be built there.
Yep.
I usually do coach people a little bit once we're going through the loan process about, hey, what to say, what not to say. Basically not say more than you need to. I've had borrowers, of course, over 15 years, I've had borrowers get on the line and just say something that didn't make any sense and had a guy go, okay, thanks, this is dead.
Yeah.
Like, for instance, I think one time we had a borrower say, hey, just so you guys know, I'm working with 6 other banks at the same time, and whoever gets there first gets a loan. you got to realize the people you're working with are also wanting to make sure that their time goes somewhere. So those types of aspects. But generally speaking, my philosophy here is really be 100% transparent. The last thing you want is something to come out once you're in the loan process that should have been brought out up front. And then that's going to kill it, right? What I've noticed throughout the years is you can handle just about anything up front, right? You can talk it through other stuff. But when it comes out during the loan process, it looks more like you were hiding it, or you just, maybe there was just some inexperience on that side, knowing it should have come out. And that does derail things. But no, generally speaking, we want to be as transparent and open as humanly possible. And especially when we're dealing with sensitive documentation like tax returns and stuff like that, try to not be an intermediary in that regard and have that stuff sent directly to where it needs to go, because the more times it hits the internet, the riskier it gets of somebody intercepting it. So.
Yeah. Okay. All right, let's move on. I want to talk, you wrote the book, Commercial Real Estate Investing, Understanding, Finding, and Funding Deals in Today's World. I know you said you wrote this a couple years ago. Yeah.
Yes. It still applies.
Yes, for sure. So I want to go through and just use it as an outline that we can talk about some of the topics in here. So commercial markets and submarkets, I think that's just going to describe the different types, right? Primary, secondary, tertiary, right?
Basically, yeah.
Okay, so we don't need to dive into that. But in here, you say ways to source off-market and on-market deals. So let's touch on that right now for today's environment. What are you seeing work for finding deals off-market? Is it specific marketing strategies you talk about in the book, or is it something else that you guys that you work on?
Yeah, no, good question. So for instance, we can actually be a good source for off-market deals, right? I'm in the market all day long. We're constantly talking to people, and we're constantly talking about their financing. And generally speaking, finding an off-market deal a lot of times is, if you're not doing like a large marketing operations, it's a lot of chance, right? It's networking and knowing the right people. There's certain ways to look at stuff and know, hey, maybe a loan's coming due and this would be when they're going to be selling, or finding, again, like somebody that was just coming off a construction loan or like an equity investor. I don't think there's one silver bullet.
Sure.
Because there's all different ways to find, and candidly, there's all different ways that like this stuff comes to us too. Candidly, like brokers can be a good source for off-market deals too, which sounds weird enough. I think if you have a certain buy box criteria, just going out there and putting it out there to as many people as you can, that has been a good resource for us to help people find off-market deals. We're not a real estate brokerage, right? Sometimes we help acquisition people find deals that we can help finance or do insurance for. And we've had a lot of success just reaching out to our network and saying, getting a buy box from a guy. Hey, we're looking for properties with 200 doors, they between X dollars in this area. And sending that out to our list of broker contacts and all of our clients, and have come back with stuff. If you don't have that type of network that you can reach out to and kind of source from, you're really at the mercy of data, right? Then you've got to start looking at title data and figuring out like a certain criteria of, again, loans coming due is a great one, or just papering people in some way. It's definitely a grind one way or another, but I see guys find these all different kinds of ways.
Yeah, for sure. I was going to say, for the loan data, what would be a top source that somebody that is, hey, I want to go find this data, where can I find it, either paid or free?
It depends on what type of properties you're after, right? Okay. Reonomy, CoStar, like all these places. Trep is a good way to find loans that are coming due. Some of these things are pretty expensive if you go that way. I think the best way to do this is to find a source that'll give you cheap title data leads. And then there's also no silver bullet here, right? Because I don't think there's a source that just sells like the leads plus all the stuff you want, plus their contact information. At a certain point, you're going to be hiring somebody in Pakistan or something to do title research for you. Yeah. But keeping it cheap and doing that, I think, is the best way. Finding a source that sells like cheap title data, and then using, again, an Upwork or something like that to get it researched is, I think, the best way to go.
Yeah. It's just thinking about building the top of the funnel. So if you're trying to get into this sort of thing, I don't know, go back to single family, the way we market, it was so many different lead sources, but you got to build the funnel. Yep. So I'm just trying to think and outline some of those items for anybody that's listening that may want to be jumping into it.
And single family. Single family is a difficult one, right? Because it's a mass marketing effort. You've got to spend a lot of money per lead.
Yeah. I was talking to a buddy yesterday, and he has transitioned everything away from what we used to do, is just like mass market, maybe $50,000, $60,000 a month and just postcards, right?
Oh yeah.
Ton of postcards going out, and he is only PPC, but nationwide, and he's doing it all virtually. And he was telling me this whole thing of how he's buying his properties now and spending very little money on doing it. But on the commercial side, again, it's like, where's this data coming from? And so Trek was one you mentioned. That's fairly expensive to sign up. And some of these things can get very expensive. So yeah, it's a good tips that you just gave to get those title
Yeah,
deeds.
believe me, I've been trying to keep our data source costs as low as possible for 15 years. So
Yeah.
believe me, we're all fighting the same fight when it comes
Yeah.
to.
And then obviously on market, you could look those up on a number of websites, LoopNet, Corexy, all those things
Sure.
that talk to brokers directly. So I wanted to talk about some of CRE's key performance indicators, another topic you cover in the book.
Sure.
So let's talk specifically multifamily. So if somebody's looking to invest in multifamily, maybe 25 to 100 unit deal, right? Looking in secondary markets or something like that, what types of indicators would you recommend they look at when going to buy something like that?
Like as far as like cap rate and
Maybe like population, income, demographics, anything like that. Are those the things that you're looking at if you're looking at buying? Because I know you've bought multifamily in the past, right? Are you still buying? Where are you in
no,
that?
we own in Chicago right now.
Okay.
If there was something compelling that came up, maybe. The issue with buying a lot of this stuff today is you get negative leverage, right? Like the rate on your loan is higher than the actual cap rate you're getting.
For sure.
And so until that adjusts, we'll see. Chicago's a difficult market though, just all the way around. It's not just, okay, so I'm looking at properties today. There's cap rate is really difficult to really get a good picture of what
Yep.
it is, because also it's not just the income side that I think is the part that needs to come up, but the expense side of a lot of these properties is really getting out of hand, especially like insurance costs,
Insurance has
utility
gone
costs,
insane.
stuff like that. Yeah, again, we're an insurance company, and just this morning I was talking to a guy saying, "Hey man, my insurance just tripled." That basically just ate up all of my NOI. Like there's nothing I can do.
Yeah.
How do your loan requires you have insurance, especially if you're in a market like Florida or Texas, something like that with a lot of wind.
Yeah.
Those insurance policies are getting crazy.
So explain to me why, being on the insurance side, why is it going up so much? Not just the natural disasters that have happened and that sort of thing. So reinsurance market, I don't understand how that works. So
I'll do my best to
Okay.
explain how it's been explained to me. One, a lot of the insurance risk was just mispriced, apparently, in the reinsurance market because of all the new natural disasters and stuff like that. And I'm not really going to get a debate into like global warming and all that stuff, but there's more natural disasters. Come on.
Yeah.
And the thing about insurance is when you get more insurance loss, it gets spread out over the whole market. You don't just say, oh, that guy's house got, flooded, his insurance is going to go up. The way the insurance companies insure is they spread the risk out across the entire portfolio, right? As certain markets are seeing they're getting more losses, they then have to spread that out over everybody. Okay, there's three things of what I commonly see in the insurance market. Insurance rates are just going up because of this more losses and the kind of the mispriced risk in the reinsurance market. And what that's translating into for people is higher premiums. And then some insurance carriers are just flat out leaving markets. Like we've seen a lot of insurers be like, hey, we're not even going to be in Florida anymore. So the supply side of insurance policies is getting smaller too, right? So that's affecting as well. The other thing that I really consistently see, and this is less of an reinsurance thing, but more something on like the retail side, is we see people get stung with policies and not able to market them because they think, oh, I have a renewal coming up, and they don't get their renewal price until 5 days before the renewal. And lo and behold, it just doubled. They're not going to find a policy in 5 days. So they have a choice. They can either take this doubling twice as expensive policy, or they can go without insurance for a while and maybe put their loan into default. So it's what it is. So yeah, so I'm telling people, like, we've been able to cut a lot of insurance policies in half just by going out there and marketing the policy in an appropriate amount of time. So if you've got something coming up, definitely get on that and don't wait for the renewal.
Yeah.
Okay, so we got to track those. So indicators for tertiary markets. I think the biggest thing that I look at in any market is what do the underlying economics look like, right? And especially when you're talking about multifamily, and pretty much it's what does the demographic trends look like in the area? It's pretty easy to tell when you're looking at like a tertiary market, right? So for instance, there's a lot of tertiary markets around here where you might find like, I don't know, a 9 cap supposedly on a multifamily property, but there's a ton of population outflow.
Yeah.
That would definitely be a red flag. Usually the properties that I see well do over the long term are ones where there's positive economic growth, like job growth, salary growth, and like positive population growth, which makes sense, which is why everybody's looking at Sunbelt states, stuff like that. I've seen so much property appreciation in Florida and Texas and places like that.
Yeah.
Like, for instance, in Chicago, where there's not a lot of population growth and arguably outgrowth, there's property values around here have been stagnant for a while. So And then without growth, you get a lot of other things, right? Like higher property taxes, stuff like that, because municipalities need to get revenue from somewhere. So we see a lot of like expense side increase as well.
Yeah. So are you buying? Are you looking for anything? I know you said you're on hold right now, but are you?
I'm selling a property and then we're going to have to 1031. So we're going to see what that looks like.
Can you intermediary your own money? You have to use out. Can you, or can you?
No. So
Maybe it's
yeah, we can use our own.
arm's length.
I don't know.
You.
That's a good question. We haven't gotten to that yet, but
anyway, yeah, sorry.
probably not. Yeah, probably not.
So what are you selling? And then what are you looking to move it into? Anything that is higher, better, and more cash flow? Or what are you looking for right now?
We're selling a 20 unit in Chicago. And yeah, we're going to try to find the right property. We'll get a decent amount of time after the sale. I think this year is probably the inflection point of where it's going to make sense to start buying. I think the underlying economics, generally speaking, are strong, right? There's still been job growth every single quarter, despite higher rates. And now we're talking about rates coming down. As far as like the lending market, we've got a great handle that there is liquidity out there. There's not a credit crisis and things are strong. So I'm starting to see property owners be more open to taking lower prices and more stuff coming in line. So I think we'll probably stick with the same asset type, just maybe not in Chicago.
Okay. Yeah. What markets?
I got to sell this property first.
Yeah.
I think the areas that I'd want to be in are probably some of the more expensive ones, like Miami or something like that. You try to be able to touch something that we're acquiring.
Are you going into Miami?
Yeah, we do a lot of deals down there.
Really? Okay.
Yeah, pretty consistently down there a couple times a year.
Yeah. Okay, so you're looking at those deals. Is that 20 unit like the main property that you like? What's your investing background as far as actually taking the income that you're earning from your active income and then investing it? Are you in passive deals? Or are you in buying more assets than the 20 unit, or what does that look like for you?
As far as investing in a property, so one of the main things that I try to do is not to have too much concentrated risk. And since our entire business is based around commercial real estate, I have invested into several properties. It's just stuff that I personally own without other investors. But they have to be passive deals. That's the issue, because the only way you can properly manage a property is if that's your main thing, right? And as somebody who works from, so I want to stay in my own lane. I don't want to run too many races and try to do like capital markets and also taking phone calls with clogged toilets and stuff like that. So no, they have to be third-party managed deals. We own a couple of buildings around Chicago.
What type of?
What's up? Yeah, just multifamily.
Okay.
Yeah. But I am also careful to not be too concentrated. Definitely learned my lesson during COVID, because I know everybody got affected, but especially like real estate came to a halt. And then on top of that, there was the issues with collecting rents and all of that. So a lot of concentrated risk in one area just makes solving any of that stuff difficult.
Yeah, I get that. Yeah, with the rents. So are you looking for other asset classes going forward or other investment strategies going forward?
I think what we probably want to do is less like direct, I would say, investment, and probably find like more like an LP position or something to invest in, something more like that along those lines. I mean, I just because of our main business, more than enough good operators, and maybe diversify the asset class. Storage, again, that's something we're looking at. It'd have to be somebody that can handle a tick structure, but I think we'll find it.
Yeah. What, 1031 out? Is that why you want the tick structure, or you just want?
Yeah, it's got to be. Yeah. So that's kind of what we've been looking for.
Yeah. That makes sense. I guess going forward, I want to see what you're seeing. You mentioned that this year you think is the inflection point. So rates didn't drop, right? Do you think we're going to get some rate drops this year? I know it's your crystal ball.
Okay. So the Fed meetings yesterday, right? And so they've been telegraphing this 3 easings, which is probably a quarter point each. I don't see any reason why they need to get ahead of themselves to drop rates. Inflation is still high, and the higher rates just don't seem to be stopping job growth whatsoever. I would tell you one of the major things that I do see in private businesses is I get a lot of calls for DIP financing, which is debtor in possession financing for like bankruptcies. And I've gotten a lot more of those, like a lot more. So
what is that telling you, and where's the opportunity there for someone investing? Is there one? Was that?
Yeah, generally speaking, I think the Fed wanted to raise rates to slow down the economy, and they usually do that until something starts breaking, right? And if I'm starting to see a lot more bankruptcies and stuff like that, it starts to show that it is causing pain and things are slowing down a little bit. And just maybe the major economy is not really able to see it yet. It's really easy to see when a public company goes out of business, but it's almost impossible to know when a private company goes out of business, right? And I think most of the economy is built around small businesses. So we are seeing a lot more of those. And then seeing like the real estate market kind of loosen up. I don't know if you saw this print today, but home sales jumped almost 10% this month.
No, I didn't see that, but
so, yeah. So it's interesting. I think a lot of the forces are going the direction of where you need them to be to get more comfortable with getting back in.
Yeah. All right. I got to ask you then again on the dip side, if I saw a business or if you had this, I guess, insight and it was a car wash or it was a laundromat or it was some kind of small business that actually was something that I would want to invest in, like how would I, or is there a way for an investor to go and either acquire those businesses through bankruptcy, or is that possible? I'm ignorant to this, so I'm asking.
Yeah, the thing is, once they're in bankruptcy, they're under that protection.
Yes.
And they may be in that for a long time.
Okay.
A lot of their assets are going to be tied up in the bankruptcy, if not all of them. There's ways that's what dip financing is, right? It's outside financing that comes in during a bankruptcy to allow the business to continue as a going concern, basically. But there are ways to get involved. You would just have to be extremely careful about, you can always put in offers to buy some of the assets. The bankruptcy court's got to agree to it.
Yeah.
But of course, these are all opportunities. But a lot of times these companies that enter bankruptcy, man, they get locked up for a long time. A lot of the fire sales, I think maybe you're thinking about, that happens in lieu of a bankruptcy.
I got it. Okay. Yeah, I just, again, I've never even thought of looking in that as an opportunity. And you just mentioned, it's like, wait a second, hang on. Is that something that...
There's something there. Every one of those things is different. Every one of those things is very different. There's definitely something there. I don't know if there's a way to get data on bankruptcies. It probably is.
Yeah. That's what I was like. Yeah. Is it only coming to lenders like yourself, or is that through an attorney or somebody's got that information somehow? Maybe in a public paper?
It's a good question. I'm sure an attorney could figure it out. We get it because candidly, it's on our website and people find it.
Yeah. Got it. Okay. All right. Any parting words, any advice for anyone jumping into investing? Any agents looking to turn their commissions into cash flow for the coming year? What are your last thoughts here?
Yeah. As far as agents, I think people are out here looking for deals. They really are. I mean, I've talked to a lot of agents and some of them were pessimistic and had given up. But from what I'm seeing, I would say for about every other client I have, there's the guy sitting on an enormous amount of cash. I know at least 6-7 groups that are sitting on private guys are sitting on $10+ million looking for deals, and they can't find any. So if you've got the marketing engine and you can pound the pavement and find deals, there's guys with money that are here to buy them.
Yeah, that's awesome. And you actually work as a liaison essentially with some of that. If somebody has a deal and they wanted to reach out to you and said, hey, I got a deal, but I need some private capital, that's your area of expertise, correct?
That's all we do, man.
Right on. Okay. Look, I'm going to put all your contact info in the show notes. Jake, it's been awesome catching up with you, learning what you're working on. If you are looking for finance or you're looking for some LP, it sounds like you do some of the LP. You put that together. What do you call that? Anyway, where you're going out and you're putting the LPs together to come into a deal.
Yeah, it's joint venture. So we're not a broker dealer. I don't do anything that's like real estate securities, but we can connect people as like joint venture partners.
Got it. Right? Got it. Okay. So if you're looking for that, then definitely reach out to Jake. His contact info is in the show notes. Wealth of knowledge. I really appreciate you jumping on and sharing your information. And your
Likewise.
Story. Awesome.
Thanks so much.
All right.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.